Good afternoon, ladies and gentlemen. Welcome to our special episode of Market Guru, where you get to meet the finest brains on the large street, professionals who have made supernormal returns for their investors, their unit holders, and of course for themselves. In this continuing series of wonderful fund managers that you've met over the last 1.5 years, we have Mr. Aditya Sood, fund manager at InCred Asset Management, joining us today from Mumbai. Mr. Sood overlooks 3 funds, a multi-cap strategy which invests 700 crores, a small and mid-cap fund which has 300 crores as asset under management, and an emerging business fund which has 500 crores. Namaste Aditya, a very warm welcome to you, and what a wonderful time to be on the large street. We've seen successive record highs coming into the mid cap and the small cap space, where you've dominated over the last so many years, and of course now the rally is being led by large caps. At 26,000 on the Nifty, is this a zone where valuations are sort of a bit edgy for you, or are these good times set to roll?
Definitely, if I look at my past, sort of framework of investing into bull markets, and it has been a raging bull market.
Yes.
Valuations of late, a lot of people have been flagging, and this is a debate which has been going in the industry for last at least, a year now, that, whether small and mid caps are expensive vis-a-vis large cap. And obviously, it has been a liquidity driven rally,
Yes.
Not in India, but also globally. One of the things that somebody has to keep in mind is that, we have not witnessed a 2.5% pullback in the Dow for last 15 months.
Correct.
So all of us are investing into India. We are very mindful about that. If you look at the index headline valuation, it is in line, at a slight premium to the 10-year average. So that is not a challenging aspect, and that is where I think so the broader market is not very expensive. But at the same time, if I have to look beneath what is going on, if I have to look at, for example, capital good index, which is trading at 10 times price to sales multiple, which is almost, equivalent to 100 PE, or the SME index for that matter, which has done, phenomenally well, sub 53% CAGR. Definitely valuation is a concern in certain pockets of the market. And what we believe is that, once you have a pullback in the market, and a very interesting and intriguing aspect of bull market corrections is that if the index corrects by 10-15%, stocks can obviously correct by 20, 30, 40%. And that is more relevant to, strategies that we run, because we are very, very focused on bottom-up stock picking. And we believe that, that will create another opportunity. Having said that, valuations can be easily married to, the way earnings growth has panned out. Post-COVID, what we have seen is that, there has been a 25% CAGR in earnings growth. Now we see a scenario wherein this earnings growth is going to, slow down, possibly, to a 12 to 15% sort of a number. So from here on, the market moves will get narrower, and obviously, we are trying to see whether we can position our clients in the right set of sectors which benefit on account of this emerging trend. But a broad-based rally obviously is going to be, sort of set to be more narrow as we move forward.
Right. Now, let's just start talking about your funds, because they have some very interesting characteristics that I have noticed. As I have mentioned, Mr. Sood manages 3 sets of funds, which is a multi-cap strategy, 700 crores, small and mid-cap 300 crores with assets under management, and an emerging business fund which has 500 crores. So overall, I see about 40 stocks that are there over 1500 crores, Aditya, and this is a very concentrated portfolio. A lot of commonalities that I can make out, for instance, Newland Labs, which is the top stock in all 3 categories, has done fantastically well. I am looking at the weekly chart of Newland Labs. In January 23, the stock was at 1300 rupees, and it is now at 12,740. This has been an awesome return, Aditya. Just tell us a bit about your stock picking framework, what do you look at? I mean, this is a 10 bagger in less than 18 months. What is the success behind such wonderful stock picking?
Sure. So, the first thing that comes to our mind, when we are investing into smaller companies is how is the character of management and whether they have, significant proof of creating wealth for shareholders in the past. So if you look at Newland in particular, if you look at the COVID low, for example, the stock is already up, 50x from that COVID low. The stock price was 250 rupees. And the stock is obviously trading at, northwards of 12,000. So the first thing is that, we want to see significant proof that this company has done well in the past. Second thing that I am witnessing, I have done small cap investing for last 20 years, and what I have witnessed is that, and this is a story of, any credible small cap in this country. When you start your business, first 10 years go to solve for, unit economics and financing. Next 10, 15 years go in terms of, establishing yourself well with your customers. But once you are established well with your customers, next 15, 20 years, you go in terms of reaping for a reward. So what is very, very unique about Newland is that it is perhaps one of the only pharma companies that I know of in this country, which has not had experience of, failing a US FDA inspection, which to my mind is very, very unique because all the large cap companies, be it Sun Pharma, be it Cipla, most of the companies have had this experience. So what is so unique about Newland? It was started by Mr. D.R. Rao, who was the head of QA/QC at GSK, and that is the DNA of the company. The second thing that we are witnessing across most of our companies is that they are very, very high in terms of innovation index. And when I say that, the total addressable market for a lot of these companies is expanding at a very, very rapid pace. A case in point is Newland, wherein right from the dossier filing for an innovative biotech in the US to identifying the API and then scaling that API from a lab scale to commercial scale is what Newland does. So our view is that with the biosecurity bill, which is slated to, which has already been passed in the US, this company is going to have massive tailwinds going forward. And the good news is that if I look at the API industry in India, the market size is $4 billion, and China API industry market size is $40 billion. So even if, a fraction of incremental China plus one has to move, it will benefit, players like Newland. Obviously, they've got very strong credentials. So when we identify companies, our mantra has been fairly simple. And it is divided into three parts. What we essentially say is that we won't overpay for greatness if we are buying a great stock in the portfolio. Yeah. So one of the things that I've learned in investing is that if I look at, Microsoft globally or Nike today, if I look at HDFC Bank or Kotak Bank, 5 years of practically zero returns, what we essentially say is that every great company goes through, 3-5 years of zero return. And that is a time wherein we would like to invest into great businesses because we believe that, great businesses gain more market share in a down cycle. So we don't like to overpay for greatness of a company. Instead of that, and this is very counterintuitive, obviously, we will wait for these great companies to underperform in the stock market because business cycles are very different from stock market cycles. And the second mantra for us has been if we buy good versus great at a discount, we'll always buy it at a discount because it is not great. And the third part of our strategy is to focus on making less errors or avoid making mistakes. And this is one of the few sports and this is a privilege that we have in portfolio management that despite making, so many errors, we still end up making, money for our clients. So what that means is that, wherever we invest, we use sizing as a play and we run, high conviction driven portfolio. So if you look at our portfolio building process, typically top 5 to 7 stocks or top 7 to 8 stocks can have, 50% weight. That means that, these companies, we understand the DNA well and mostly, we have invested with these companies for last decade. So once you know the DNA, obviously you can invest because that in an upcycle or in a down cycle, how these companies are going to fare.
Okay. I'll request the PCR to please fire the chart of BBQ Nation and possibly this is a zone which Aditya has recently talked about, that this is a great company not doing anything well for the last so many quarters. The long term chart, I'll request the PCR to file. And of course, while we've been around in a bull run in small caps and mid caps, here's BBQ Nation that has dramatically underperformed over the last 2 year, 3 year period, and trailing at multi-month lows. Aditya, is this the theme that you are looking at when you look at stocks to invest in? That the quality of the management is superb, but the stock for some undescribable reason has been out of favor. Here is BBQ Nation, ladies and gentlemen, an all-time high of 1150, and the stock is at 648 now. Aditya, to you.
Sure. So if you look at the stock price performance of this company, possibly it got listed at, 450 rupees. The stock made an all-time high of 1600 rupees. But subsequently, what we also saw is that, the QSR sector went through trouble, and there was a slowdown, and the stock made a low of, 500 thereabouts. So one of our key mantras has been that, we believe that Jubilant FoodWorks, incidentally, is one of the best performing QSR stock, and it is known to people. It was a small cap from 2014 to 17, and I was a Jubilant FoodWorks investor. One of the things that I would like to highlight is that obviously QSR is a very, very difficult space to operate into. It is a consumption sector, but people don't believe that we have cycles in consumption. As opposed to that, we believe that the best time to buy a restaurant or a QSR company is when same store growth is negative. And this is what has precisely led to this decline from 1600 rupees to 650 odd rupees that we see today. Our belief is that this decline is temporary. So when BBQ went IPO, they had a store count of 155 stores. Today they have a store count of 213 stores. In a down cycle, they consolidated the position, because what a market leader will do is to consolidate its position. So what BBQ did precisely was to acquire two companies known as Salt and Toscano. Now, to our mind, both these acquisitions have been value accretive for BBQ as an investment proposition. So our belief is that, it is a combination of both the things. They are experimenting with the new formats of moving away from Indian cuisine to Italian, which is Toscano, and also sort of experimenting with fine dining, which is Salt for them. So our view is that as the cycle progress, as the cycle mean reverts, your same store growth will rebound, and this is not new. If you look at Jubilant FoodWorks from 2017 to 18, similar sort of thing happened with Jubilant FoodWorks, wherein the stock price was down by 67% in those 2 years. But subsequently, the stock went up by 10x. So our view is that when there is a temporary headwind in the sector, that is a time we would look at, because we are buying all these companies at a much reasonable valuation, and that is what our core belief is.
Okay. If I may persist with another question on BBQ Nation, what was your first lot purchase on BBQ Nation, and what is the average cost across portfolios?
Yeah, so when we first invested into that company, it was at 750 rupees, but on our way down, we have averaged it out. And if you look at our strategy, when we are buying companies which are declining, let's say I'm buying BBQ, which is already half from 1600 at 750, we would buy a small weightage. But as the things start to look up, near term, because we track all these companies very closely, since it is a very, very concentrated position that we run. What we believe is in sizing. So there could be a quarter wherein we are very confident about the same store growth, so we can easily double the weight in the portfolio. Okay. So size is a very, very critical play for us.
Okay, and ladies and gentlemen, please bear with me. Let me just look at the top 3 stocks or 4 stocks across portfolio that Aditya manages, and you will hear recurring names. That is the beauty of this portfolio and Aditya's stock picking. We are now talking about the small cap and mid cap portfolio. The first 4 stocks are Newland, Tejas Networks, Indraprasth Medical Corporation. This is the Apollo hospitals in Delhi, and a little known auto ancillary called Igarshi Motors. The fifth one is Muthoot Capital Services. Let's look at the portfolio where you have the multi-cap portfolio. Again, you have amongst the top players Newland, Indraprasth, Tejas, Igarshi, and then a fifth company from the mid-cap IT space, Intellect Design and R Systems International. In the emerging business fund, look at the top holdings. There is Newland Labs, again an echo. There is Indraprasth Medical, again an echo. Stovecraft and Cholamandalam Financial Holdings as well. So, ladies and gentlemen, this repetition of names across portfolios actually looks at concentrated positions, and as Aditya has pointed out, at a time when the cycle is turning, this is where Mr. Sood increases the weightage of the portfolio as far as these particular stocks are concerned. Aditya, what has been your most recent purchase?
So it has been Indraprasth Medical and our systems. We added both these stocks in last 6 months.
Indraprasth Medical and
Our systems.
R Systems International. Okay, this is a mid-cap IT company which sort of has done pretty well. I remember R Systems somewhere like 275 about 6-7 months ago. Let us see what the price is. Could you please explain the logic behind Indraprasth Medical? Hospital chains have done fantastically well over the last 2 years or so. What made you choose IMCL? Was it just attractive valuations?
I think so. Attractive valuation in the case of IMCL was a given. Just to do a quick recap, if you look at this company, last 10 years, they have not added a single bed to their facility. It is a 755 bed facility that they have based out of Sarita Vihar in Delhi. So our first belief, our starting point was that, the stock is extremely cheap. It was trading at 5 times EV by EBITDA, 10 PE. So we started to probe that why the stock is very cheap. Incidentally, this is one of the few hospital stocks wherein the return on capital employed is northwards of 40%. And you can imagine possibly it is the highest return on capital employed if I have to, rank hospitals by ROCE in the world. And the reason is very simple that they have got lease from Delhi government. This is the first PPP between Delhi government and Apollo. And what we found very intriguing was that, they had a cash pile of 250 crores. I'm just taking you, 1 quarter back. And the key question here was that, when they expand, because this was more like a 8% top line growth company, 12% bottom line growth company. And what we found out essentially is that, now they have got 300 crores of cash. The trailing PAT for them is, close to 180 odd crores. So this was the highest ROCE hospital stock, but trading at I mean to say it was trading at 1/3 of, or 1/4 of the sector average.
Yes.
So what we said is that, we would really like to back Apollo as a promoter, and the missing ingredient here was growth. And now, as we understand that over a period of time, since they are accruing cash on the balance sheet, they are going to go big time for growth. So our view is that, over the next 3-5 years, they can expand from 755 beds, all funded through internal accruals, going to 2000 beds. That would obviously translate into at least 400 crores of PAT. And we believe that obviously there is an element of under ownership because we were perhaps one of the first institutions to buy the stock. Now we have seen, some mutual funds also buying the stock. So it is a combination of, a value stock getting re-rated to become a growth stock.
Okay. I have been tracking IMCL for the last 2 decades. It's next door to our office. Do they mention somewhere that they'll be increasing the number of their beds? My apologies, but I don't remember reading it.
So it is in the annual report that they have mentioned this time around. As you might be aware that there is a huge problem of parking close to IMCL. So they are trying to address that issue. So first they would have to, address that issue. But one thing that you have to also bear in mind is that, if I look at the average revenue per occupied bed, RPOB, it is one of the highest in the sector. It is a 70,000 rupees average revenue per occupied bed. All this with not 25% margin, but with 18% margin. Because, obviously as a obligation to the Delhi government, they have to treat patients also. So we believe that there is minimal risk to margins here. Obviously, they would do reasonably well, and anytime they should expand.
Yes, and ladies and gentlemen, 26% of IMCL's equity is held by Delhi government. That was in exchange of the land that they offered Apollo, and I am talking about maybe 25 years ago. And for all of us living in South Delhi, this is perhaps one of the finest hospitals that one can come across, very consistent too. Let's take Aditya's word for it and wait for it to flower. For the last 2 decades that I have tracked this stock, practically nothing has happened. And now that Aditya is in it, let's hope good days are rolling. Are systems for you, Aditya, how do you defend that thesis?
I think so. It is a very unique company. It has recently gone through a management change wherein Blackstone Group came and bought 52% in the company and made an open offer at 280 rupees. What we find very interesting about this company is that it is first of all, the average revenue per employee is in the 55,000 US dollar range. So if I have to just compare the peers like Mindtree, Persistent, companies which have done well in the IT sector, these companies have an average revenue per employee in the range of 40,000 US dollars to 45,000 US dollars. Now this is very interesting that they have a sort of average revenue per employee at a higher rate. That also leads me to believe that obviously they are doing some work which is high value add for their clients. It is very, very logical to believe that. We believe that broadly the next decade or next 2 decades would belong to products. And that is the reason why we have Intellect Design Solution also in the portfolio. What happened to services is going to happen to products, because essentially, we see all the ingredients of products doing well over next decade in IT services. We also believe that, if you look at the headline numbers for this company, last 10 years, the top line has grown at 13% CAGR. Obviously, profitability has grown at a much faster pace. Last 5 years, ex of Blackstone, the top line had grown at a 15% CAGR. Now they have recently done an acquisition of a company known as Velatio, which is now being integrated. So we believe that this company can grow at northwards of 20% CAGR for next 4 or 5 years, gaining market share. Blackstone has set up a very ambitious target of inorganic and organic growth from a $200 million revenue headline number to possibly targeting a $1 billion number over a 5 to 7 year period. So we would have to see how value accretive the acquisitions could be for this company. But this is clearly a company wherein, as you know, in terms of IT services, what typically happens when the sector does well, mid caps do well, and it is all a function of dollar revenue growth being 2x of let's say Infosys, Wipro, or a matured company like HCL Tech. So our belief is that this company should do well structurally. There is limited downside since you have Blackstone as a new owner in the company, and hopefully the cross sell and upsell. There is both scope for hunting and mining. They have got very good customer base. And what was clearly missing in the past, obviously, was that there was nobody in the company who would have gone and bagged a $10 million total contract value. And this is what is changing since we have got Nitish Bansal, who joins from Infosys. He was the head of ERD in Europe, and he has done a phenomenal job in terms of his track record in the past. So we believe that Nitish and team are going to replicate the success as a team, and possibly this is a 5-7 year play. The stock is clearly not cheap if you look at the valuations today, but that is just fine. I think so on a base of $200 million revenue top line, acquisition can change the trajectory of the company.
And what we've seen over the last 3 years is that a lot of PE investors who have come into particularly this pharma and tech space, they've created a lot of wealth for individual shareholders and of course institutional players. So the thought process, according to me, in our systems, what is going in your mind is that Blackstone will be in the driver's seat to get global deals. The gentleman from Infosys will be kick-starting the internal program, and of course over time you will see higher sales and higher profit numbers. Is that the thesis?
Yeah, I think so. Perfectly placed. We believe that, it is about, it is one of the few industries, as we have experienced in IT, wherein a private equity player comes in. These companies are very easy to turn around because essentially they are all managed by professionals. Just look at the number of, I cannot recollect, a company which is not owned by IT, which has not had a private equity as an investor in IT services. So it is a very very interesting play. Obviously, there has to be a trade-off between growth and sort of compromising on the average revenue per employee metrics that are pointed out. But I think so they would be in a better position to accelerate growth going forward.
I have a particular question to ask you, Aditya. It's obvious that you hunt pain, and that works very well when the cycle turns. Now look at Newland Laboratories. It was at 250 rupees in the depth of COVID, at a time when probably pharma should have outperformed. And here is a stock which is now at 12,000 rupees. In this journey, you have added to your quantity. How do you make a decision that time is up, ladies and gentlemen, time to book some profit, and let's enjoy the benefits of our labor?
So point number one here is that, Newland incidentally has been a 100-bagger stock, since the time I first put my money to work, which was in the year of 2011. So one is knowing about the DNA of the company. Secondly, recognizing the inflection points in the journey of last, 10, 20 years becomes very, very important. So if I look at DV's lab as a, best performing pharma stock, so when I go and speak to people, which is the best performing pharma stock as a case study, the name of DV's comes to mind, right? Which is the next DV's is our endeavor to find, if I have to put it like that. The second thing is that, whether it has ingredients of being, reasonably priced, that becomes very, very important. So if I look at Newland, for example, from the COVID low till now, broadly in last 5 years, the top line has doubled. Margins have moved from 15% to 30 odd percent in terms of EBITDA margins. Obviously, they have moved from having slight debt on the balance sheet to being highly free cash flow generative. Obviously, there is a huge tailwind of biosecurity bills, getting passed in the US. And my belief is that only 3 companies in India qualify to benefit from such a large change, which is a combination of DV's, Syngene, and Newland. Now, if I look at Newland, broadly, last 5 years, they have doubled in terms of bottom line. Our belief is that next 3 to 4 years, again, the profitability will double. This 300 crore PAT number that we are witnessing today would become a 600 crore PAT number. So there is clearly element of growth. The stock is not very expensive. It is not trading at something like a 40 PE 1 year forward or something like that. Our belief is that, on FY26 numbers, possibly Newland is reasonably well positioned in terms of earnings. The low hanging fruit is out. Obviously, I would like to qualify myself, but whether it deserves a part in the portfolio, obviously it deserves a part in the portfolio, because what they are trying to do and achieve, and if you go and speak to Newland also, the company will tell you is that, some of the inquiries that they are getting from various geographies. For example, they were amongst the first, one of the first few companies to go to Japan and get an approval from the regulator there, essentially. So our view is that, there is huge tailwind and the stock is reasonably priced.
Okay, and that, ladies and gentlemen, is one of the best defenses I have seen of an investment thesis in a very, very long time. Even after a 2500 percentage point uptick, here is a stock that can give you quality returns even from these levels. My last question to you, Aditya, I wish this conversation could go on for 4 or 5 hours. I would never run out of queries to tap your brain into. What now? Because large cap on a relative basis is undervalued compared with mids and smalls, where you've turned in such a decent return. In your portfolios, I don't see a private bank, I don't see an auto stock, I think there's Hero Motors if I'm not wrong. And I don't see any of defense plays which have done phenomenally well. Why have you kept away from such themes?
So in our framework, one of the themes is that, we have to avoid hot sectors in the market, and defense has been the best performing sector. But if you look at defense companies today's, you will find companies trading at 20 times revenue, or 10 times revenue is a threshold. So as a, growth at a reasonable price sort of a framework, we don't tend to invest into anything wherein, price to sales is northward of 10 times basically. So that is point number one. And one of the things that I have learned in my earlier sort of investment avatars is that money is also made by avoiding errors, and it is a very, very important point as a part of our framework, that the lesser mistakes that we make also makes money for investors, right? So one has to stay very disciplined across market cycles. We have held, having said that, we have held, Bharat Earth Movers in the past. It is a company wherein we made money, but at the same time, it is our job as a fiduciary of clients' capital to stay disciplined, as a lot of things are happening. So our view is that we can be value seekers in this market, whether we will have, opportunities. Once we have, a 10% correction in the market, we can have 30-40% correction in our portfolio stocks only. If you look at Tejas Network as an example, I'll just elaborate this with the help of an example. The stock was languishing at 550 rupees for the longest period of time. It was in a very, very tight range, 550 to 700. But then eventually what we saw, a move from 550 to 1550 within no time.
Yes.
And today the stock is trading at, closer to 1200 sort of a level. So it has gone through correction, and correction is a normal course of stock market. Ownership keeps on changing hands. The only caveat here is that whether we can increase our conviction when the market, when these stocks correct, whether we understand these companies reasonably well, and more importantly, how is the incremental risk reward when we are putting our money to work. So we have got two rules in our company. One rule as a part of our framework says that we will not invest into any stock wherein the IRR on paper is 20%. And this is a rule that we are religiously following. Secondly, the risk to reward has to be minimum 1:3. And by that, I essentially mean 10% downside to 30% upside. And if we find 1:5 risk to reward, we size. If we find 1:10 risk to reward, 100% upside to 10% downside, we mega size. So that is how we think about it. It is a very interesting way to think about it, but more importantly, how to implement it at a practical level is what keeps us going. And look for optionality in the set of companies that we are investing into. We always want to buy companies wherein there is a combination of PE multiple re-rating and earnings growth, so that if earnings growth doesn't happen, we still have PE multiple re-rating supporting us.
Off the top of my mind, the last point that you mentioned, I think Tejas Networks, Indraprasth Medical, and R Systems International plus BBQ Nation, all of them will have PE expansion plus earnings growth.
Yeah. So that is a very, very important point. You are creating a safety net for your investors, because you are buying companies in a down cycle, but you are also ensuring that they do well.
With that, ladies and gentlemen, I think it's sadly time to call it time with Mr. Sood. What a wonderful 35 minutes it's been. Aditya, you've defended 4 or 5 very good stocks that are at the moment either lying dormant or are inbuilt and pregnant with a lot of developments, and I hope a lot of investors who've listened to you and viewers who are queued in will do a bit of their own research and maybe look at positivity as far as our systems is concerned. Tejas Networks, Indraprasth Medical, and of course that wonderful stock called Newland Laboratories. Thank you for your time, and I hope you enjoyed the conversation as much as we did.
Thanks for having me on the show. Thank you a lot.
That, ladies and gentlemen, was Mr. Aditya Sood, a very well-known fund manager who works at InCred Asset Management. He runs 3 schemes a multi-cap portfolio worth 700 crores, small and mid-cap scheme worth 300 crores, and a new fund emerging business scheme for 500 crores. All put together 1500 crores spread over 40 stocks, some of them really common, and a lot of them he defended on the markets. Please do listen to this interview again and again to find out how good quality stock picking is done, and when it matters most, you go in for size ups or to mega size ups when the risk and reward is in favor of you. Thank you so much for your time. Please remain glued to Business Today Television. There's a lot on the other side of this break.
Kiran ji, telecom space में what will you be looking at today after yesterday's drubbing in some of the stocks yesterday? Do you think there will be a comeback? Will you be looking